the CFTC just announced that they would allow for a pilot program for using BTC. They specifically call out BTC, ETH, and USDC as collateral in derivatives markets, and also issued guidance on tokenized collateral. So, Matt's been talking a lot about these changes in the underlying structure of our legacy financial markets. I know he's going to want to go into detail on this, but I want to call out here, here are the two staff guidances. You can go look these up. I'm going to just kind of highlight these here. Tokenized collateral guidance, and then this one I thought was really interesting, a staff no action position regarding digital assets. Essentially, they had a compliance question from a regulated entity saying, hey, we want to be able to utilize these digital assets. CFTC, do you have any specific guidance here? And the no action, you're never going to get a yes, go ahead, go do this. But the no action is effectively the way that they would do that. So, Matt, I'm going to flip it over to you here. You had some, I think, key insights that you were able to pull out based off of some of the research you've done. But in your kind of framework, how does this affect the legacy financial plumbing by enabling Bitcoin, stable coins, et cetera, as collateral?
Yep. So the CFTC action and there's
Yep.
3 letters, I think, that they issued that bundled up. And then the key output of that is, as Cameron, you got it in the headline, there's going to be a pilot test launch of a program that allows, they call them FCMs.
Yep.
The exact acronym, it's Futures Commission Merchants, maybe, or Futures Commodity Merchants, I want to say. What are those things? They're basically like the equivalent of a broker dealer in securities. They're that base layer between or that middleman, sorry, between the exchange where everybody just meets and the I guess in the physical version of this, these don't exist anymore as everything's moved digital, but like the open outcry exchange pits, right? And then those individuals or FCMs trading on the pits are ultimately conducting the trades on behalf of their accounts, right? Client accounts. They can also trade for the firm or the house themselves. But that's what this is. So they're going to launch a pilot program where, so with a futures or a derivatives contract, what you're doing is you're just one-on-one, you're engaging in a transaction that will settle in the future, right? So you have something, could be a security. You can trade you can do S&P 500 futures, right? You can do fixed income futures, interest rate futures, currency futures, or you can do commodity futures. Yeah, and that's where the metals comes in. And yeah, so when you want to engage and just take a side of a futures contract, you match up with a counterparty taking the opposite position. It's someone's got to sell if you want to buy, or vice versa. But what people do, or what the exchange requires you to do on the back end, is post collateral, right, for margin. And you can actually lever up. You have 100 nominal dollars worth of product that your futures position says you're going to settle. You may only need to reserve or hold like $10 in collateral behind it. And really that's just to get the price moves netted out on a daily basis, so that you're not building up credit risk between counterparties. Like that's what the exchange provides services on the back end, is for that counterparty netting on a day-to-day basis, just due to price moves in the contracts that they've agreed to against spot market prices. So in the US, like, you can go to the CME, they publish everything, like just the list of assets that they'll allow for collateral by these FCMs, and the haircut, right? So if you post, let's say, a treasury bill, you will take a 0% haircut. Like, it's dollar for dollar money. It's money good. If you post gold, I forget what the number is. Maybe I can't remember. I did a talk on this last year at the Space in Denver where we went over this. And that number for gold, maybe 85%. I can't remember. That might be the new Basel III guidelines. But CFTC and the futures exchanges, they have their haircuts for all of these assets, corporate bonds, other sovereign bonds, et cetera. And they'll tell you, hey, here's how much we'll count that for as in terms of meeting your margin requirements. This pilot test, the significance here, it's not the first one. The US is not the first sovereign regulator to allow, like call them cryptocurrency assets as collateral, right? But the US is both the largest futures market in the world, and its approach here to integrate native crypto assets. What I mean native, that technically they're the only crypto assets in my view. But you start with Bitcoin, and then they also say they'll include Ether, stable coins, right? Because you gotta get consensus to get changes made. And the sad fact of the matter is it's a much bigger consensus. It's a bigger tent when let's say the stakeholders push for regulatory changes once you add in the crypto bros and the venture capitalists who come along with them. Sad to say, but it just is it is what it is. But the CFTC, I'm just going to say Bitcoin here from now on, just because my house view, that's what matters. They are going to integrate with and allow for Bitcoin collateral directly to serve as or to operate as assets, providing the margin requirements and backstop behind the futures transactions that take place on the U.S. exchanges. Any questions so far, Cameron?
No, I think, from my
Okay,
perspective too, like a big thing here is not having to convert that Bitcoin into something else also, right? So if you're
true.
seeing all of this, there's been a lot of noise made about some of the stable coins being used as actually just a way for people to, use the crypto rails to be able to trade crazy derivatives or
Yep,
whatever it is. This is saying you don't need to go do all of this, wash trading, whatever it is, to get into a coin that you can then use as
yeah,
collateral. You can just do this with the native Bitcoin rails.
yep. You'll have to. It's the real thing. It'll be
Yeah.
collateralized with UTXOs. But there may like you're not just going to be able to show up to the the building in Chicago and post your cold card or
Drop your cold
your
card on the
ledger and say
steps.
I'm good for this. No, you'll probably have to custody it with a qualified custodian like a bank, broker dealer, etc.
Yes.
But it's coming. Um, Now, the US isn't necessarily the first to do this. So you've actually seen two other markets already go and kind of get a head start. The key thing here, though, is the US represents, I already said it's the largest, futures, derivatives, and swaps market globally. So the value already lives there. And then it's Bitcoin, right? So it's porting that onto Bitcoin. I'll go over what that means in a second in my framework. Two others that did this with digital assets, right? You had Dubai with its VARA, Virtual Assets Regulatory Authority framework, launched in 2023, 2024. But it's tiny. Like there is not much, futures, commodity, all that trading out of Dubai. Claims to be the capital of capital, the upstart. Like it's kind of the region that if Europe and the London banks had their choice, they would want the center of gravity to move towards the Middle East and Dubai, as opposed or Abu Dhabi, Dubai, I would say, just UAE, period, as opposed to that center of gravity shifting towards New York or Shanghai. But it's small and it's digital assets themselves, which is I view this as a $10 fancy word for just saying it's like private blockchains, whatever. It's not solving the fundamental core problem or offering the solution that Bitcoin is as an open, um, censorship resistant, you know, ledger money that solves the Byzantine generals problem. Like, so this thing we're going to put tokenized real world assets, other digital assets, all that stuff, and they're going to collateralize tokenized securities, stuff like that. Um, it's a different approach. You're not plugging into the thing like the network effect that Bitcoin's already built up, and then you're also not porting over a massive amount of value that's already established, and where just stakeholders across the globe are engaging with each other as financial counterparties for settlement um, in the United States already. So Dubai first, but they're different, small, and they're not even doing it on Bitcoin, or call it native cryptocurrency. When you see that, just scratch that through and say Bitcoin, and you'll see the signal through the noise, in my opinion. Then Hong Kong as well with its SFC, the Securities and Futures Commission, began this VATP, virtual asset trading platforms, just product launches. Um, but it's the same thing, very similar. It's a virtual asset derivative trading. Um, like in my view here, you're trying, like what these approaches are trying to do is look at a new technology like Bitcoin itself, and then trying to copy paste that technology onto something different, create a new use case, not realizing that the actual new technology, the only thing that matters really of importance is Bitcoin itself as the protocol for settlement and counterparty free custody. So those two are the ones that are already off for the races. Now, the US is the first major, I would say, to adopt. And its policy approach, everybody's got to come up in this new world, right? Where, the table just got turned over. Everything's up for grabs. After 2008 was really the starting point. But you're seeing the US make the policy decision. It's going to build on Bitcoin. And then they also list Ether and stable coins in there, which, in my opinion, as this goes on, those will become less and less relevant. Now, for the other majors, you see they're in sync or trailing. You have Japan, where it's tested a proof of concept, but it's focusing more on the tokenized, its regulatory leadership is focusing more on the tokenized securities approach. So just, hey, let's tokenize the stocks and bonds. Um, and then the United Kingdom, which is focused, if you think about UK, right, just look at its politicians, look at King Charles, you'll hear them say tokenized real world assets are RWAs, right? So from this approach, what you're thinking of is, oh, hey, we've got some forests and timberland up in Canada, or hey, Calgary or Alberta, you've got some oil and gas assets. Let's just, slap a claim on those. We'll throw it on a blockchain and we'll call it a tokenized asset, whatever, and we'll trade it like it's, an Ethereum or Solana or all this stuff. And that'll form the basis, the collateral basis of our futures, swaps, and derivatives markets. So I think if you're really looking at this from the zoom out perspective, each one of these sovereigns has to come up with a policy, right? And in the fog of war, everything's confusing. But the fact that the US is aggressively focusing on, what I guess in the broad sense, the word for this is the crypto native assets, like Bitcoin itself. Um, that's actually the foundationally correct move in my, prognostications of how this will play out. So it's an extremely positive development for U.S. Centric policy when you're looking at this broader, I guess, conflict that we're discussing pretty much on a weekly basis with this regionalization and geopolitical conflict. All right. So in terms of like first mover, US wasn't first, but it's the first to get it right, I think is my big takeaway. And then it's also first because, or in the sense that it is the largest. So in terms of like notional outstanding or total scale of swaps, futures, derivatives, just all these paper contracts out there, the US is the global behemoth. It's just a quick search. I think, where is this from? I think this is an ISDA number. But there's 250 to 300 trillion dollars in notional derivatives outstanding. And all of that has to be collateralized by something, right? And in the old model, it's just, the snake eating its tail. Everything's collateralized by debt. The debt the debt itself is the asset, and we just rinse repeat, grow this bubble, and you're just building up a house of cards on a very weak foundation, in my opinion. That foundation like just buckles every time you see a financial stress event, 2008, 2020, etc. And what you're seeing everybody move to do, from a sovereign standpoint, is kind of take steps to shore up their foundation, pour more concrete, get a little bit more, rebar, etc. Um, and in the future, as these key players, these regions compete amongst one another and trade with each other. The ones that get it right and build that solid foundation for the financial system will be where the capital flows, in I'd say the centuries ahead. So in term, like another call out here, I think something interesting. So futures specific volume, of the CME Group's U.S. Treasury futures alone trades an average of $774 billion per day, according to 2024 data. So if you think about all of this, the $38 trillion national debt, why does the debt need to keep going up? It's because that is the base layer collateral in the legacy framework, not just in the United States, but in London as well. We'll get into that in a second. But this CFTC pilot is basically, the text here calls it a 0 to 1 moment for crypto, but really for Bitcoin itself, but then also the financial structure, that's built on top of that. I think the other key thing here for the US, it like the policy approach it's taking, it doesn't have to start from zero. We're just going to, rebuild. There's still, probably law that needs to get done. We might need an update to the 40 Act. I'm not a 40 Act lawyer, not a professional, but there are, I guess, just questions, just gaps in the legal interpretation, regulation, all of that's going to need to be patched for, this kind of novel invention that showed up on the scene in 2008. But I'm confident that will get done. And like basically what you're going to see is adoption of this Bitcoin technology on the United States, financial framework. So what we talked about was sentiment. Hey, why isn't Bitcoin going up? It's actually been in a consolidation now for, going basically a year since that November 2024 election. It's not quite yet Bitcoin's time in the cycle, for that up move that you're seeing right now in platinum, copper, silver, gold, etc. But its day will come, right? So, I guess I'll just one more sentence here. Even like a tiny fraction of this collateral market, like you've got all these derivatives, 250 to 300 trillion. Those have to be backstopped by real collateral. The actual preferred right now, the most common, it would be assumed to be U.S. Treasuries, right? The CME, the CFTC, they don't post like a list of, hey, what's being applied as collateral, or what are these FMCs actually posting? But it's broadly presumed like it's going to be heavily Treasuries. It's just favored. You get the best terms, lowest haircut, all of that. Largest market as well, most liquid. But over the last, at some point in the last 5 years, the spot market in Bitcoin to US dollars, if you think about concentrated dollar liquidity in one asset, right? I think Bitcoin is on par with, say, a T-bill, QSIP, or like the 2 year, maybe not quite the 2 year on the run treasury, but trend, like the amount of liquidity in the Bitcoin to US dollar, FX exchange rate pair, if you think of it that way, it's already massive. So porting over Bitcoin into that collateral layer will have massive implications going forward on, I don't want to make a prediction or put a time on it, but the further you roll the tape forward, 1 year, 2 year, 3 years, the more important this comes as like that value transfer of the collateralization effect works its way into the 21 million Bitcoin supply. Um,
Got it. Do you want to maybe
Comparison, yeah, go
I
ahead.
would say maybe we skip this next section. Do you want to focus actually on you mentioned the UK piece? I'm really curious
Yep,
about that. I think there's
yep,
you put together this global leaderboard. I want to put it up on the screen here for
yep.
everybody.
Yep. So the global leaderboard, this is 2024 notional numbers based on, this is just interest rate derivatives, right? So you're just comparing, swaps, calls, et cetera, on interest rates. And this is coming from the ISDA and BIS data. But it says United States notional volume, they claim approximately $366 trillion. Now that was, if you zoom out and what did the last number show? 250 to 300.
Yeah.
That might be market value. I'm not sure. But yeah, notional value up front would be, hey, how much, what's the basis for an interest rate calculation? So you take a few percentage points in terms of what's going to be settled. Um, and that's the actual like value transfer that would change hands between counterparties and an interest rate derivative, is how I would think those two numbers square up. But yeah, 366 trillion in notional outstanding for interest rate derivatives. It's dominated by SOFR and your Treasury futures. Now in second place, you've got, I mean, it's less than half. UK, 172 trillion. This is legacy. Like London was New York before New York became New York, essentially, in terms of capital market center of gravity. Um, and this is where, yeah, they lost their big product since the, you know, 1950s, 60s, the first LIBOR, you know, rate settings taking place between the major global banks out of London. Um, and then just the heyday of LIBOR indexed uh, credit products, so mortgages, et cetera, anything variable or floating rate between, say, the 1980s, once we got out of the 70s great inflation, um, basically from that 1980s period to 2022 when LIBOR was deprecated. UK owned that market. So what you're seeing is just a change of the top of the leaderboard, and the US is just running away with it, right? And then in third place, you've got the EU with 76 trillion. It's much smaller. You think about the UK and continental Europe, always being in competition with each other for just financial markets activity, capital, et cetera, in the old school kind of European colonial model. Even combined, they're not even uh, at par with the United States anymore. So this is a big development. And everything you're seeing when you listen to the collateralization, like anything related to collateralization of futures, derivative swaps, et cetera, and the changes in policy that are going to take place, if it's someone out of the UK, you're going to hear the words RWAs, tokenized assets, all of that stuff. You're not going to hear Bitcoin. And then same thing out of EU. You're going to hear Christine Lagarde talk about the digital euro. We're introducing this novel product. It's going to be the best thing since sliced bread. It'll be online cash. It'll be offline cash. They don't even have a real product, right? They're selling against vaporware specs out of desperation, in my opinion. Um, but you can see this taking place at the collateral layer in the US. You know, what we saw with that December 8th announcement and those three policy or staff letters. Um, Rescinded in the announcement of this pilot program, you've seen, you know, the number one, the lead horse in the race, they're going to collateralize Bitcoin. So huge development as this goes forward. So one more slide. I know I can kind of tend to get academic here. Let's go to
Yep.
14. Cameron, do I have
Lead you
control?
over.
Okay. So popular book, you know, especially as, you know, the tech companies started to dominate the US economy by the 2010s, it was apparent, right? Google, Apple, Facebook, Amazon, all of that. Um, this book, The Innovator's Dilemma, became really popular, not just in the venture capital community, but I would just say like the MBA program
I mean, it
minds,
was
like
required
just
reading when I joined
canon.
Amazon. So, yeah, yeah.
Oh, really? Cool. All right, awesome. It's very academic, and I'm not sure that many people actually fully absorb what's going on here. But I'm going to try to explain it in terms of what we just saw with the CFTC adopting what I view as the disruptive technology, which is Bitcoin, right? So if you think about settlement products, like what is Bitcoin itself? It wears it right on its face, out in the open. Pick your favorite metaphor, right on, you know, right on its sleeve, what it is. It's in that first Genesis block. Chancellor's on brink of second bailout of banks. It's um, it's a protocol where nobody can change the monetary parameters, which is basically just ensuring everybody's on an equal playing field. Your competition, your peers, your distrusted counterparties, you don't have to trust them. You just have to trust that this protocol credibly guarantees that no one else can change the rules, right? And that's at its core what it is. Um, Probably not the best explanation of it. We could go much deeper, and other people could do a better job than me. But in short, that's what's going on. And so, if you think about the you know, Clayton Christensen disruptive technologies framework, you've got a new technology that arrives, right? So if you go through his book, he'll talk about hard drives, right? And you go from magnetic tapes to spinning hard drives, then you get SSDs. There's always a new technology, and then you have, um, I guess, the private sector coming in to build products on top of those technologies. And ultimately, what they're trying to do is deliver products or services that consumers demand in the marketplace, right? That's all you're doing. And so if you go on the y-axis here, you've got product performance, high to low. What does that mean? Just better products, right? Start with crappy, then they get better. Um, so over time, what you actually see is these technologies will show up as, you know, people make discoveries and they invent new things. Just what humanity is capable of. We're a creative species. It makes us special. And what you'll generally see is competitors in the same product market space um, come to adopt those technologies in their product mix at different times and to different degrees, right? And so at that level of that, the y-axis, the product performance, you kind of assume that what customers will pay for, they always demand better product performance. We want faster horses, better whiskey. There's a third one there in the old country song I won't get at. But they just want better stuff, right? The consumer just always wants better. Same way like your car, right? The Model T started in like one color. Like everybody got the same thing, you know, and then eventually you put in air conditioning, power windows. Now you have an iPad. Now they self-drive. It's just customers always demand better features, right? Um, and so what the new technologies actually allow for is the displacement of the legacy incumbents who may not choose to adopt that new disruptive technology because, like there's various reasons. It could be the cannibalization effect. They don't want to put resources towards, changing their product mix to integrate a new technology, et cetera. But for whatever reason, they don't. And that's where the innovator's dilemma comes in. They eventually get to the point where they have to bet the farm and integrate a new technology or risk being disrupted, right? And that's why no one holds on to the number one position in a market share forever, right? In general, like track record's undefeated, same way Father Time is, right? So, in my view here, what we're seeing when Bitcoin arrives as a disruptive trajectory, right? What does it serve first, right? You start with like different tiers of the market. There's a low end, middle, high end, et cetera. Imaginary levels here, but in practice, where do you actually see this in the real world, right? Go back in time and think in like 2010, 2013, who was the product or the customer base that Bitcoin was actually serving as a disruptive technology? It was, the product was the Silk Road, right? Yeah. So you're serving the low end of the market, black market, drugs, generally like non-permitted goods, according to the state, in most sovereign jurisdictions. That was the first customer base that Bitcoin served. Probably the least profitable. It's the low end of the market. If you look at what Ross Ulbricht made in terms of Bitcoin profits in that phase, say it probably made a decent amount as like a tech startup, right? Um, but in terms of actual value transfer, it was nowhere near what like a settlement marketplace or like base layer settlement, like say the Fed was earning on its business, or you could also say other settlement products, or just treasury collateralized settlement, all of that, right? But as time goes on, you eventually see those incumbents make that choice of whether or not to adopt that disruptive technology. And as this whole process is happening, you're seeing new disruptors. So Coinbase is one of these FRMs, right? Who is a key party in this CFTC pilot program. They're going to be one of the FRMs, most likely, in this pilot program. So you get new disruptors. And if you also look at the financial firms sort descending by market cap, Coinbase has really shot up that list in the last 10 years, like going from startup to nothing. So you see examples where firms that adopt that disruptive technology um, outcompete incumbents, build new markets, build new products, et cetera. But then the incumbents that adopt as well will outcompete their peers. So that means, hey, if a bank in the U.S. is incorporating Bitcoin into its systems, all of that product mix, et cetera, it might compete or outcompete over time against its relative peer group of fellow US banks. But you could also say that too for sovereign jurisdictions too, like financial systems themselves. The US regulated financial system. What's the proxy for that? The US dollar, right? Um, the onshore US dollar. SOFR, all of that. You would expect it to outcompete other sovereign competitors, UK, EU, Shanghai, etc. Um, it doesn't have to be a winner take all either. You can have different sovereigns cooperating with each other, forming factions, teams, etc. Like we've talked about, U.S. plus Argentina, Japan, etc. You see nation states coming together to form alliances, and that's showing up in the headlines. But my opinion right now, this CFTC pilot program, if you're thinking about these lines, see those red lines, you see the incumbents sustaining trajectory. This is just the steady state. If the CME did nothing, they would eventually start losing market share to other competitors, right? But over time, that disruptive technology works its way up. It serves, 15 years ago, it was serving, just people buying drugs on the internet. Now it's serving mainstream audiences. You can find, just do a survey of US adults and households. A sizable percentage of them own Bitcoin at this point. A lot of it's through ETF or synthetic exposures, whatever. It is what it is. And then it's working its way up to what I would call the high end of the market, which is ultimately going to be the international trade settlement. So, one example, we talked about this a couple of weeks ago, talked with the Russian oil divestitures, right? Value, like the key channels of value are international trade. Like you buy low and sell high, and you put the thing on a shipping container. That is where a lot of the value transfer takes place in a globalized world, right? And then the CFTC, purview kind of represents, we talked about the commodity trading houses, right? And you think about, oh, who are the U.S. Ventures there? Well, number two is Castleton Group, which is owned by Paul Tudor Jones, probably our most notable Bitcoin figure. I know within Bitcoin, if you look at the follower index, you're just going to see Michael Saylor show up as the most widely followed and um, just making the most headlines advocate just for what he's doing with strategy and the equity space. But I think your highest signal Bitcoiners are the people involved in the finance niche of international trade, of commodities themselves, and then settlement and collateral. And I would include Scott Bessent coming from that world as well. So that's, Cameron, we said we're not going to talk about predictions for 2026. This may not be just a 2026 story. We're going to get the pilot off the ground, but this is a medium to long-term story. This might take 2, 3, 4 years to play out. But that's what this headline is showing, that Bitcoin is working its way up the stack and in terms of ultimately serving the highest end and most profitable customers in the
Yeah.
market.